All right, let's get started. Welcome for our Thursday live webinar. Today, we are so excited to be hosting Stephanie from Asset Preservation, who will speak to us about 1031 exchanges. Welcome, Stephanie.
Thank you, Stacy. I'm really happy to be here. Thank you so much for inviting me today. I appreciate it.
Yes, it's so great to have you. 1031s are just such a powerful tool for wealth preservation and growth. So we're so excited to have you. I'm going to do a few quick housekeeping items. So first, we always love interaction. So I just want to ask everybody to feel free to drop your questions in the Q&A box below. Please drop them in the Q&A box, not the chat box. But we do kindly ask that your questions remain vague that could apply to everybody. While we want you to get the help that you need for your specific situation, we do recommend that any details to your situation are discussed with a professional like Stephanie. But otherwise, as far as the disclaimer goes, today is meant to be broad education. If you have specific questions, always feel free to contact your own tax professional, an attorney, or any other person that can help you with the details of your situation. Again, this is just meant to be educational. So, Stephanie, I'll let you take it from here.
Okay, thanks so much. Um, so yes, my company is Asset Preservation. We are a leading national qualified intermediary. We're actually one of the largest in the United States. And we actually just celebrated our 35th anniversary last month in March. So we've been around for 35 years. And we've performed well over 200,000 tax-deferred 1031 exchanges on behalf of our clients. Let's get on to the next one. So this is kind of what we're going to be covering today. Obviously, tax code 1031, which is tax deferral on the sale of a property used in a trade or business or held for investment when exchanged for like-kind property. We're going to go over capital gains taxes, exchange entities and why those are important. What is like-kind property? What is the holding period? The difference between a regular delayed and a reverse exchange, and the identification rules. So 1031s have been around for quite a while, since 1921, so it's not new. It's just people are starting to use them more as they're learning about them and learning to understand what an actual important tool it is. It allows taxpayers who are holding real property for investment or business purposes to potentially defer all of the taxes that would have otherwise been incurred upon a regular sale of the investment property. So when clients have the properties, they've got options. They can hold the property and, see what the market's doing. But if they're in a low growth area, it might be a good time for them to sell. They can sell their property and pay those capital gains taxes. Or they can do a 1031 exchange where they can, again, potentially defer all of those capital gains taxes and reinvest them in new investment property. So what are some of the reasons that people want to do a 1031 exchange? Say they've got a property with almost no debt or low debt and got a lot of appreciation. It might be a good time to leverage up and possibly buy 2 or 3 properties. They purchased it for 300,000 and now it's worth 800,000. You should redeploy those funds and expand your real estate investment portfolios. Diversification is another one, either by asset or by geography. So say they've just got retail net lease properties, maybe they want to go into some single family or vice versa, industrial, all different types of asset diversification. And then geography. You want to make sure that you're picking the right locations for your properties. And RealWealth Network is really good at helping people figure that out. What are the good places to have those properties around the country? Maybe you're in California, which is not very landlord friendly. So maybe you want to have your properties in a different state. Consolidation. Maybe you've got multiple properties and it's getting hard to manage all of them. So you want to sell a couple of them and then invest in one larger property. Cash flow, that's kind of the main reason that investors are purchasing properties, real property, because they want to increase their cash flow. Management relief. Say they've got, again, multiple properties. Maybe they want to consolidate, go into one that's going to be easier to manage than multiple properties. And then estate planning. That's one of the main reasons that people want to do exchanges as well, is because they're planning for the future and their heirs. What's going to happen when I'm gone? I've got one large asset. Maybe I should break it out into three so that each kid has a property of their own, and then there's not going to be any fighting later. So those are some of the reasons people might be interested in doing a 1031 exchange. Capital gains taxation. This is the big deal. This is what we're trying to defer. So first off, there's a 25% depreciation recapture. There is a 20% federal, 3.8 net investment income tax, and then state taxes are going to vary. In California, which is one of the ones with the largest state tax, it can be up to 14.4%. So you're going to want to find out what your state taxes are and play that into your decision when you're deciding if you're going to do a 1031 exchange or not.
Do you mind if I ask a clarifying question? Is that taxation on depreciation for the lifetime of ownership with the property, or is it only in the most recent tax year?
No, it would be for the lifetime of the property. So
Perfect.
27 and a half years is basically the full depreciation for a rental property, like a single family property. And that's usually up to 75% as the amount that they're able to depreciate. So sale versus exchange, this is just an example. Assume a married couple filing jointly sells an investment property in California for $1 million. The couple originally purchased the property for $400,000. So this one has been fully depreciated, so it went down 75%. And so now they've got $100,000 is their new adjusted tax basis. So 300,000 of that is going to be the depreciation recapture. So now their new capital gains are 900,000. That's a lot, especially when you play in all four of those levels of taxes. So what does that look like? So they sold the property for $1 million. 300,000 was depreciated from that 400,000 purchase price. It was fully depreciated. So there's a 25% recapture on that. 600,000 for federal. So 20% on that. 900,000 net investment income tax at 3.8%. And then 13.3% is the one I put in there. And so you can see from $1 million, they're going to be giving up almost $49,000 to the IRS. That's if they did a sale. However, if they chose to do a 1031 exchange, they can defer all those taxes and redeploy those funds into a new property or multiple new properties. So what does that look like? So we're going to see if they could leverage up to purchase more properties. The most they could do after paying taxes in the sale would be 2.6 million. Whereas if they did the 1031 exchange, they can leverage up to as much as 4 million. You can see how that would easily, more quickly help them expand their investment real estate portfolios. So this is a really, really important tool for everybody to know about and to use. It's there as a gift. So use it. Expand your investment portfolios. So what does the code actually say? The code says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade, business, or for investment. So it's pretty broad what you can do with your investment properties. So exchange entities. So this is really important. So the 1031 exchange is a tax code. So you want to make sure you know who's doing the exchange. Sometimes there might be an LLC, there might be a trust. Ultimately, though, what we're looking for to find out is who is the taxpayer entity and make sure they're identified properly. Otherwise, it could blow the exchange. You need to make sure that you understand who that is. So some examples, if the wife is selling, then the wife is acquiring. If the LLC is selling, then the LLC should acquire. Same with a corporation and with partnerships. So again, the key here is who is the tax owner? We always want to make sure that we are aware and that we are identifying ourselves as that entity correctly. Okay, like-kind property. What is like-kind property? So all these properties qualify as like-kind property. So it's pretty broad. You can go from raw land to industrial, to apartment buildings, senior housing, student housing, retail, net lease. So lots of people think that like kind means, oh, if I've got a single family home, I need to buy another single family home. You do not. So you can actually, really diversify your portfolio by investing in other types of assets. Okay, which properties do not qualify? So a principal residence does not qualify for a 1031 exchange. That would be your tax code 121, where you get the 250,000 for single or 500,000 for a married couple. Also, people who are doing flips. Flips do not qualify as a 1031 exchange because a flip is considered inventory, and the 1031 exchange is only for investment property. So that's how you make that distinction there. You can buy a property, fix it up, but then you need to hold it for long-term investment purposes. Okay, so any relinquished real property held for productive use in a trade or business or for investment can qualify as 1031 allowable properties for exchange. So you see down there again, raw land, commercial, single family, multifamily, office, all of those count. So split treatment. Say your client, or say you, sorry, are in a fourplex and 3 of the units are rented out and one of them is your primary residence. You can use both tax code 1031 along with tax code 121. So they can take, say a married couple is living in one, they can take 500,000 out for that 121, and then they can 1031 the remainder of that and reinvest in new investment property. We always want to remember that investment property for investment property is what is real property for the 1031 exchange. Now, can you convert your residence into a rental? Yes, you can. And this is a really good way if you've owned a property for a long time and you're getting ready to sell, but you want to maybe not deal with those capital gains taxes. You can take that residence and turn it into a rental. You have to, and then you can use both tax codes. Again, you can use tax code 121 and you can use tax code 1031. So as long as you've lived in the property for 2 of the past 5 years, you can take that either 250 or $500,000 out and then do a 1031 exchange with the remainder of the funds left over from that. So this is a really important one for people who are trying to make sure that they can continue to expand their real estate portfolios and really not have to get hit hard with those the capital gains taxes that you get either on a primary or on a rental. So what is the holding period? How long do I need to hold my investment property? So technically, there is no actual hold time. So conservatively speaking, there is a private letter ruling by the IRS indicating that if you hold the property for 24 months, that pretty much satisfies their requirement for the standard of holding the property for long-term investment purposes. If you're going to do it less time and it's planned, you want to try and have a minimum of 12 months and possibly straddle 1 or 2 tax years. So you have to establish it through your taxes that it's being applied as investment property. Again, there is no hold period. I had a client recently purchased a property for $350,000. He had a paper trail basically indicating what his intent for the property was. He was going to be building on the property and he was going to put a couple of little rental properties on there. So he was talking with construction, he was getting plans, he was working on zoning, he was talking to realtors. 8 months later, somebody came and offered him $850,000 for the property. So he and his CPA decided that they had enough of a paper trail to show what his intent was when he purchased the property. So they felt that they could go ahead and do that 1031 exchange because ultimately, at the end of the day, what is the intent? That's what they're looking for. So you want to make sure that there's a paper trail that shows what your intent is if you're going to be holding it for less than 24 months. Okay, exchange equation. So if you want to do a full tax deferral, you must meet 2 requirements. The first one is to reinvest all of the net proceeds that you get from the exchange. Second one, you want to acquire a property with the same or greater debt. So let's see what that looks like. So they're selling a property for $900,000. They had $300,000 debt. The cost of the sale was $60,000. That amount does not need to be reinvested. So closing costs and commissions can be taken out and they don't need to be reinvested. So at the end of there, you're going to have $540,000 left over. So you'll move over, they're going to buy a property for 1.2 million. So they're going to reinvest all the net proceeds, and they're also going to increase the amount of debt from the 300 to 660, and then they're going to end up with a replacement property of 1.2 million. So any amount that's not reinvested is referred to as boot. And you can see over here, this boot, there's no boot. So there's no monies that are subject to capital gains taxes, and they've effectively deferred all of those capital gains. Can we do a partial exchange? Absolutely, we can do a partial exchange. So what does that look like? So partial exchange means you're not necessarily going to reinvest all the net proceeds or all of the debt. So here they're relinquishing their property for 900,000. Again, they have the 300,000 that is debt. 60,000 closing costs doesn't need to be reinvested. They have $540,000 of net equity. They're going to instead choose to keep $100,000 of that. So that's going to move over there to the boot column. And they're also not going to reinvest all of the debt. They're not going to replace all of the debt with new debt. So as far as the debt goes, the debt needs to be replaced either with new debt or with cash, just so you know. If you want to, basically you need to just make sure that any amount that is not reinvested, be it cash boot or mortgage boot, is going to be subject to capital gains taxes. So you can see over here, we've got $140,000, 40 of it mortgage boot, 100,000 of cash boot. And so they're going to be paying those capital gains taxes on just that amount right there. Okay, what are the steps to take prior to doing a 1031 exchange? You always want to consult your tax advisor. You want to make sure that you need to do a 1031 exchange. If you bought the property like 3 years ago and then you did a bunch of improvements, maybe you're not going to have that much appreciation and maybe it won't make sense to do a 1031 exchange. We really only want people to do 1031 exchanges if there's a need, because there's a lot of rules and boxes that you have to be in to complete the 1031 exchange effectively. And so if you don't need to, we're not going to suggest that you do. Consult a qualified intermediary once you've established that a 1031 exchange pencils out for you. Confirm who the taxpayer entity is, and then confirm that the purchase agreement and the tax ownership are matching. Okay, regular delayed exchange. Let's get this moving. So this is a regular delayed exchange. Excuse the little arrows upside down. I don't know why that happened. So the taxpayer is going to sell their property, okay? And a buyer is going to come in and purchase the property. When escrow closes on that purchase, the funds are going to be wired to your qualified intermediary. At Asset Preservation, we hold your funds in a non-commingled account in a large national bank, so that your funds are safe. So you're going to sell your property. The buyer's going to send the money to escrow. Escrow is going to wire the funds directly to us. Now, your exchange needs to be set up prior to close of escrow. And the reason for that is in a 1031 exchange, the seller is not able to have constructive or actual receipt of the funds. So it needs to be set up prior to close of escrow so that your escrow officer knows where to wire those funds. So the funds are going to be held with the qualified intermediary. At close of escrow on your sale is when your time clock starts. So you see you've got 45-day identification period, and then you have 180 days to close on that replacement property. So it's really important that I usually suggest people start looking for the replacement the minute they go under contract, because 45 days goes by really fast. And another really great thing about RealWealth Network is they really do help people find those replacement properties that might otherwise not be easy to find. You know, they do lots of the vetting, they figure everything out. So it's RealWealth Network is a really great tool for anyone who's doing a 1031 exchange to have in their back pocket. So yes, they're going to purchase the property. When they get the earnest money deposit, we send that out, and then we'll also send out the funds to the purchasing side when they're ready for that to happen. And again, it has the first 45 days of that 180 days is their identification period. So what are the identification rules? So there's three different rules. The first one is called the three property rule. This is the one that most people use. Basically, the taxpayer or the client or the seller can identify up to three properties of any value. Say that's the important part. They can identify up to three properties of any value and close on one, two, or all three of them. Should they wish to identify more than three properties, they can do that. That's called the 200% rule. So they're going to put a cap at the amount you can identify. And that's identification with all of the properties combined. So 200%, say they needed to reinvest 500,000, the most they can identify with all the properties combined would be $1 million. So if they want to identify more, they cannot be of any value. They're going to put a cap. But then there's a third rule, the 95% rule. So they don't want to be, they want to identify as many as they want, and they want them all to be of any value. They can do that, but the 95% rule indicates that they have to close on 95% of whatever they identified. So they better be certain at the end of that identification period that whatever they've identified is going to close. Otherwise, it will blow the entire exchange.
So that makes it more risky then.
Yes, that one will make it more risky unless they absolutely know that there's nothing that's going to hinder that close.
Yeah.
So how does the identification need to be done? It needs to be made in writing and signed, unambiguously describe the property. So if it's land, then obviously an APN number might work. If it's a regular property, you're going to want the address. And if there's a suite number, make sure to include the correct suite number. It needs to be hand-delivered, mailed, telecopied, or otherwise sent. So email does work. We'll send out identification forms for your clients to fill out. And the rules are going to be on the identification form to make it easy, but they're going to need it to be signed. So they will need to print up the identification form, sign it, scan it, and send it back, or have somebody set them up with a DocuSign, because the signature needs to be on it. They can't just send me some, hey, Stephanie, I found this really great property on the corner of Hill and Lake. I want it. I'm identifying it. No, has to be unambiguously identified, and it has to be signed. Sent by midnight of the 45th day. So this is important. So during that 45-day identification period, you can put an offer in on a property. Maybe it doesn't get accepted. That's fine. We don't need to know that the offer's been put in. The offer gets accepted. We still don't need to know. Once it goes through its the inspections, that might be a good time to let us know. And say then it falls out, you change your mind. You can unidentify that property, but it also needs to be done in writing and it needs to be signed. So whatever you've got on your list by midnight of the 45th day, those are the only properties you can close on. So again, it's really important to have a good realtor, make sure inspections are done, or work with RealWealth Network to help you really find those strong properties that you can be confident that you're going to be closing on. Because again, if something happens after that 45th day, your exchange will no longer be allowable. So this is pretty much the identification form that we send out. You can see over on the left and on top that we've got the property, the identification rule. So the three property, the 200% and the 95%. So it's easy for your clients or for you to see which one you're identifying, and lines and a place for the signature. So can we sell multiple properties and purchase one? Absolutely, you can do that. One thing you want to make sure, though, is if you're selling multiple properties to purchase one property, the identification period begins at the close of escrow on the first sale. So you want to make sure that maybe you've got some options to extend the close to allow for the other two to sell, because that 45 days, again, does come quickly. And you want to make sure that you have enough time to get all three of the properties sold within that time period, because you have to close again within 180 days from the sale of the first property. My clicker's not working. There it goes. Okay, and can you sell one property and buy multiple properties? You can. So when you sell that one property, your close of escrow occurs. You have 45 days to identify those replacement properties. So that's going to be a little tougher because you're trying to get 3 of them in there. And then they have to close on all 3 of those within the 180 days. So you can sell multiple and purchase one, or sell one and purchase multiple. Both of those scenarios work. You just need to be conscious of the timing. Okay, a reverse exchange. A reverse exchange allows a client to purchase their replacement property first. Say they're worried that they're not going to find the replacement property, so they want to, get that all in order first, or say they just come across a property that looks perfect and they can't pass it up and they don't have time to get theirs sold first. So they can do that. Sometimes it's more, might have issues with the lender because they're not always as comfortable lending when someone else is going to be on title. So what happens with a reverse exchange? So the client's going to put in their offer. Then they're going to call me right away because we need to create an LLC. The LLC is going to, so the taxpayer puts in their offer, the offer gets accepted. They call me, we create an LLC. The LLC then becomes the exchange accommodation title holder. So we're going to step into that contract, and we're basically going to purchase the property on behalf of the client. The client is then going to put their property on the market, and when escrow closes, is when their identification period starts, but in reverse. So they're going to have 45 days to identify what they're going to sell and 180 days to close on it. Because maybe they have multiple properties, they find the property, they don't know which one they're going to sell. So they have 45 days to identify what they're going to sell. And again, 180 days to close on it. So we're going to step into, we're going to purchase the property on behalf of your client with your client's funds. Either they're going to have cash, or they're going to possibly get a loan, or maybe the seller will be willing to do seller financing until they sell their property. So those are some of the scenarios. And while we're holding title to that property, we're basically, in essence, going to lease the property back to the client, the seller. And so they're going to have full management of the property. They can fix it up, they can put renters in, whatever they need to do while we're holding the property. But you want to make sure that the property you're selling is priced correctly, because it needs to close within 180 days. If the property doesn't close within 180 days, then you're going to be stuck with 2 properties, the replacement property and the one that you were trying to sell, because after 180 days, we're giving you back control of that property. We don't want to keep it. We're just holding it for you up to 180 days. So it's important. So you're going to sell your property. The buyer's funds are going to come into us, the exchange accommodation title holder. Then the property is going to be deeded, and the money is going to go back to the seller when you finally sell your relinquished property. So that's kind of how all that works out. So it is possible to purchase your replacement property prior, either because you're nervous about not being able to find a replacement, or you just happen to come across the perfect property and you don't want to miss the chance. Okay, can a 1031 exchange be set up at the last minute? Yes, it can. We just need to make sure it doesn't close. I've had people call me on the day, like, I'm supposed to close in like 3 hours. So what we need to do is we need to call escrow right away and stop the closing. Don't close. Then call your qualified intermediary, make sure they get you set up. We contact escrow. Escrow sends us the forms. We get everything set up. If everyone's moving quickly enough, usually we can get it done the same day. Sometimes it might take a day, though, to get things moving. But they can happen at the last minute. We don't recommend doing it at the last minute, but it can be done at the last minute if you need to. Just make sure you don't close. Again, because the escrow company needs to have wiring instructions prior to close of escrow. Otherwise, you might have, IRS might view that as constructive receipt of the funds. Even if they're not in your hands, it would still be constructive receipt if the funds are allowed to be released to you prior to close of escrow. Okay, so here's some social media. Here's my contact information. So if anybody has any questions, I'm happy to do some Q&A right now.
Yeah. Absolutely. We
Only thing
actually
that's
do.
personal to you though, and you're feel free to give me a call. Um, I'm always available to hop on a call and explain the whole process again to everybody. And I look forward to hearing from you.
Thank you. Yeah. And if you're unsure if a 1031 is correct for you or you have more questions about your specific portfolio, you're always welcome to reach out to your investment counselor and book a strategy session with us too. That way we can clarify any questions before handing you over to Stephanie. But either way, definitely feel free to reach out. So we do have a few questions here, and I personally wanted to highlight first the partial 1031 is something that I had just recently found out about and had never heard of. And I feel like a lot of people are not aware of that. I've heard a lot of education be all or nothing with a 1031. Do you mind touching on some of the reasons that you see a partial being important to use? Like if somebody had debt to pay off or just some of the additional benefits, because I feel like it's definitely a missed important highlight that people are not aware of.
Yeah, so there's many reasons people might want to do a partial exchange. Like you said, they might have debt they want to pay off. Maybe they need to fix up another house, maybe college funds, all kinds of different things. But yeah, the nice thing about the partial is you don't have to reinvest all of the funds to do a 1031 exchange. You can keep a little bit of it out. Say you were supposed to reinvest 900,000, but you found this perfect house for 800,000. You can still do the exchange. You're just going to have some money left over. So it's minus closing costs and commissions. So maybe your capital gains are not going to be all that much when you're doing a partial exchange. If they're doing a partial exchange just because they want to pull money out for something, but they're not looking forward to having to pay those capital gains taxes on it, they can also choose to do a full exchange, reinvest all those funds, and maybe refinance that property that they just purchased and pull some money out of that if they need funds. But yeah, it is important to understand that sometimes people just don't want to replace the debt. They're like, I just want to reinvest the proceeds. I don't want to replace the debt. I don't want any more debt. Like I've had enough. So yeah, a partial exchange is a really great way to defer most of your taxes and still leave you with some cash at the end if that's something that you really need.
Yeah, perfect. Um, David asks, isn't boot if additional funds are added to the new purchase?
No, you can always add additional funds to the purchase. So if you're supposed to invest 500,000 and you decide to purchase the property again for like 1.2 million, that's fine. The only amount that counts as boot is any net proceeds that are not reinvested and any debt that is not replaced with either new debt or with cash.
Perfect. Craig asks, and I'm going to try to paraphrase this as best as possible. If he sells a property for 800 grand and he has a 200K mortgage, he has 600K left to reinvest. Does he have to buy the next property for 800K and come out of pocket for any difference, or does he only have to buy a property for the amount of the equity that appreciated?
Yeah, so he needs to again reinvest all the net proceeds, so that's 600,000, and he needs to replace the debt either with new debt or with cash. And again, it would be minus the closing costs and commissions. That amount does not need to be reinvested.
Perfect. Karina asks, would a vacation rental property in a foreign country qualify as a replacement property?
So that's twofold. So foreign countries, you can do a 1031 exchange in a foreign country, but it has to stay in the foreign country. You can't exchange foreign into the United States, and you can't exchange from the United States out. As far as vacation rentals, yes, they can qualify, but there's very specific rules regarding vacation rentals. So you have to own the property for a minimum of 2 years. It has to be rented out for at least 2 weeks out of each year. And you cannot use the property for more than 2 weeks per year or 10% of the amount of time you've had it rented out. So if you had it rented out for 200 days, you could use it for 20 days.
Perfect. And then are there any different laws or regulations for US friendly countries? Jake asked about Costa Rica specifically, or is it just any foreign country is a foreign country?
As far as I'm aware, any foreign country is a foreign country. I don't know if
Perfect.
certain countries might have different rules, but generally speaking, you can go from one foreign country to another.
Erica asks, do you help your clients fill out the ID form to ensure it's done properly?
So when we start with you guys, so I'll get on the phone, I'll go over all the rules, make sure you understand everything. I'm going to contact escrow. They're going to send me the forms. Then I'm going to review everything and send it over to our headquarters. At our headquarters, you'll be assigned an exchange team. So the exchange team is going to be with you the whole way through the process. So if you have any questions on how to fill out the identification form, then the exchange team would absolutely help with that.
Wonderful. Erica asks, is depreciation recapture still taxed if they haven't been claiming depreciation on the rental?
If they haven't been claiming it, then I don't believe so, but then they would still be subject to that 20% for federal.
Perfect. Charlotte asks, if my LLC in Pennsylvania sells a rental, can it be exchanged for another property in Ohio with my LLC in Ohio being the buyer of this property? So it sounds like her question is
Can
more
they
on
go
that.
from one state to another state? The same out? Yeah. Yeah.
And it just sounds like her question is also the LLCs being different.
So again, what we want to establish is who's the taxpayer entity. If the LLC was paying taxes, then the LLC is the one that's purchasing. But sometimes an LLC is a disregarded entity, meaning the LLC is strictly there for liability purposes, but ultimately the taxpayer is the individual. So you want to just check with your CPA to confirm who is the taxpayer entity. Is the LLC the one doing it? Like, is it a sole member LLC and ultimately the individual is the one doing it? Or is it an LLC that is actually the taxpayer entity? Then that exact taxpayer entity is the one that needs to do the exchange.
Perfect. Can you do use parking lots or garages? Do they qualify as replacements?
Yes, those would still be real property.
And then are there any stats regarding what percentage fail to in the 1031 identification at the 45-day mark? Do you have any?
I don't. Honestly, I
Yeah.
don't know. Um,
Does it feel common?
oh, no, no. I
You
mean,
guys
most of the
effectively do a
time,
lot.
our clients are able to find an identification, a property to identify.
Yeah.
Um, but there is a G6 restriction, so just so we're fair. So say they're in the 45-day period and they decide at day 30 that they're not going to do that. We have to hold their funds until the 46th day. And that's not our rule. It's a G6 restriction that's in the tax code. And then say they identify their properties and they're past the 45 days, say they're at day 100 and they decide they're not going to close on anything they have, we have to hold those funds until the 181st day.
Okay.
So
Yeah, I think that's the biggest thing I learned from this today. I actually was one of the people that did not know. I thought like kind had to be like multifamily to multifamily. I did not know you could change asset classes. So that is huge and opens up a lot of doors for sure.
mhm.
David asks, do you mind talking about any fees or what you charge for your services?
Sure. So we pretty much do industry standard. It's $1,250 for most. There are a few Northeast states where we've got different pricing, and that's just because they use attorneys instead. Um, but for most of the states, it's $1,250. I think the most we charge is 2,000, and that's only for there's 8 states where we have to charge a different fee because they use attorneys, and that fee is based on the amount of the property sale that they're doing. But it starts at 1,250, and the highest we go up to is 2,000. That's for a regular delayed exchange. That's for the sale of one property and up to possibly the potential of 3. If you're in the regular states, if you're in the states where they use attorneys, then it's a 1-to-1 sale. If they want to purchase more than one, then there's an additional $200. Now for reverse exchange, those are more expensive because we're creating an LLC and we become a title holder. It's usually somewhere between $7,000 to $9,000. So that's something else to consider if they're thinking about doing a reverse exchange. It is quite more costly to do a reverse exchange.
Yeah, that makes sense, especially with that entity creation there. Do you mind
I just
speaking?
quoted our for this year. I don't know when you might watch this. We're in 2025.
Yes. Do you mind speaking to some of the reasons somebody should choose you guys over competitors, or what are the differences between the companies with a 1031 exchange?
Okay, so the really interesting thing is qualified intermediaries, we're a non-regulated industry, and not everybody knows that. So there are certain state regulations that are put on us, but federally, we're non-regulated. So there have been some bad actors in the past who have invested people's money or used it incorrectly or absconded with some of it, and then their funds are not there on the other end. So we have what we like to call basically the API advantage. So we've got expertise, experience, and security. I mentioned at the beginning, we've been around for 35 years. We've performed well over 200,000 tax deferred 1031 exchanges on behalf of our clients. We're a member in good standing with the Federation of Exchange Accommodators. But we've also got, so we've got all of our E&O insurance, and we've also got an extra layer of security for funds with one of our, we're under the umbrella of Cisco Information Systems. They're a New York Stock Exchange traded company. And they provide an extra layer of protection for our clients' funds, as basically if something were to go wrong with the funds and it was our fault, Stuart then comes in and helps with that. So you just want to make sure you've got someone who's got the experience, the expertise, and understands the security of taking care of your funds. And again, we keep them in a non-commingled account. We've got the relationship with the large national banks that we hold those funds in.
Yeah, that's amazing. And I hear such good things. Even so many of our staff members here at RealWealth have used you guys, and everybody just has rave reviews. So thank you so much for highlighting that important factor. Zena asks, in the future, how will the base value be calculated for new properties if you exchange one property for multiple?
That would be something specific they'd have to discuss with their CPA.
Okay, perfect. And then, given the tight deadlines, do you have any tips for investors to ensure they hit the IRS deadlines?
Yeah, I mean, working with Real Wealth Network is very helpful because they're going to be able to find those properties for you that you may not otherwise find on your own. Also, I suggest the minute you go under contract on your sale, you really start looking at your properties and getting your inspections done as soon as possible to make sure that you've got viable options at the end of the day, at the end of the 45-day period.
Yeah, I completely agree with that. And to your point, the amount of new construction that we're able to offer investors really caters to the need of this because there's so many different timelines of the construction. So you can really choose between markets and different opportunities to be able to identify and hit those. So yes, that's all of our questions. I think, is that all of our slides too? Yes. So feel free to reach out to Stephanie, connect with her, ask her more detailed questions about your personal scenario. But then again, if you have any questions about if this is right for you or if it's something you should consider, always feel free to reach out to your investment counselor and schedule that strategy session with us. But otherwise, thank you so much for joining us, Stephanie. It was so great to have you.
Thanks for having me, Stacey. I really appreciate the opportunity to get on here and talk to people about the importance of the 1031 exchange.
Yes, it was so great. Thank you again. Have a good day.
Thanks.